No one will ask you. But I have musical questions.
Chicagoland on ABC was a certain brand of television, which I was very proud of. But I really wanted to spread my wings and do more.
I should do
And this was a real opportunity to do so.
So you go over to Netflix now, when when somebody's famous and they move, let's say, in a baseball player or a football player, they go to a different team or somebody tries something different, people are always saying, this person isn't really as good as their reputation, and they're gonna flop. There's a lot of, I would say Hollywood, maybe there's some people that don't like people that are too successful, and so they're kind of wishing secretly maybe they're gonna flop. But you didn't flop, you had an incredible hit. Your first show, Bridgerton, was the most successful show of any Netflix ever. Whether it's a success or that you not panic.
You know what's interesting? I wasn't scared about the success of the show. That's not my job. I always say that. I was happy by then because Netflix was already happy. Everybody liked the show. Everybody was really pleased with it. I wasn't worried about numbers. I wasn't going to do it. One of the things I liked about it was so I wasn't worried about that. I was much more nervous when we were editing the show and we were seeing what the product was. But I wanted to see what the shows turned out as and how they felt. So once I knew the shows were good, and I wanted to watch them, I felt really good about them, and I felt like they could be and then it turned out the same way. I felt fine. I don't even think I could do it the very first day.
You also started another show that'll be coming on Netflix called Inventing MAH01983, which is about a woman who pretended she was a wealthy German heiress. It turned out she was not. Why did you think that was going to be attractive for a series?
I was fascinated by the story. Because I really loved the journalism that went behind the race. But two, Anna is a really interesting character to me. She's truly a genius. And I also think that if she were a guy and she had pulled it off, you would have just enjoyed it. But I think because she was a woman and she sort of had the audacity to believe that she could do this, it felt a little bit like an affront. She was sort of labeled in a lot of ways that I don't think we were men. And I love this idea of this woman with all of this ambition and there's something about it that felt really profound to me and felt very now for where we are now.
So when you're writing something, it's a solitary kind of thing. How do you do writing, but also you're doing production and you're doing other things? How do you concentrate and have the time alone to write?
Well, you know, there is an aspect of writing that is communal. You know, there is a writer's room where it's you and sort of 7 or 8 other writers, and your job is to sort of help them through writing their drafts of the show that you've created.
Hello, everybody online. Hello, Zooms.
Happy belated birthday, Professor.
Oh my God, how did you know?
You told us.
That was blowing it.
Did you have a good birthday?
It was very nice. It was very civilized. We went to Napa, you know, hung out by the pool, you know, drank some mojitos.
Went clubbing, very civilized.
Clubbing, home by 3, you know, it was really up by 5. It was really fun.
Wild.
Yeah, it took me 3 days to get over the hangover. But I'm back. I feel great now. All right. So how'd you guys enjoy my birthday? Did you guys have a nice weekend? Did you?
Clearly not as well as you celebrated your birthday.
Oh, yeah. It was, but there was always drama. You gotta love the drama. Always.
There has to be. There has
Gotta
to be.
be
Otherwise,
some
it's
drama.
not a birthday.
Exactly. Especially this was a milestone birthday.
25?
I think it's
24.
No, my 50th was worse. No, this was way better. Don't turn 50. That's my recommendation. You know, anything after that and before that's great. But the 50th's the worst. All right. So where did we leave off?
We left off with talking about.
Well, let's do the market updates really quick too, and then we're going to do the exam. this in a minute, but let's do the market updates. So where did the Dow Jones Industrial Average settle today? Was it up or down, by how much? And can you give me a few factors that are driving the markets?
It was up. It landed at 30, well, right now it's at 34,837. And it's up 0.03%.
Okay,
It dropped 36%.
wait a minute, how's that work? I got dropped 36% over here.
Right now it's green. I think that means up. Does it?
Oh,
Yeah, that's,
this one says at close, 4:55 PM.
so where did the Dow Jones Industrial Average close today? Is it up or down, by how much? And can you give me three factors on, all right, why? Come on, remember you're like a trader in the pit at Goldman Sachs, right? It's like, what's going on in the marketplace? Dow Jones Industrial Average closed. I heard it, was it up or down by how many points, and can you tell me why?
Now the Dow Jones Industrial Average, they went up 16 points or 0.05%, and one contributing reason for that is stock was pulled back due to the fear of the spread of COVID-19 and the Delta variant again.
Okay, what else? Any movements in interest rates? Did Jerome Powell say anything scary? Did any earnings estimates were missed or hit, or what's going on?
The Fed had a meeting today at 2 p.m. in regards to stabilizing interest rate.
And what did they say?
They have yet to.
Are they going to keep the punch bowl at the party? Are they going to keep interest rates low? Or are they going to start tapering in the first half of next year?
They said that they will start tapering.
Okay, when? Now? Next week? Next year? Do we care? Do we care if the Federal Reserve starts raising interest rates? Yeah. Yeah. What if they raise short-term interest rates where they actually short-term interest rates are higher than long-term interest rates? What happens? What happens when the yield curve inverts?
A recession happens.
Yeah, in 24 months. Do we care?
Yeah.
Yeah. I mean, do you guys want to be looking at a recession?
No.
Would you like to know when it's going to come
Yes.
so you can plan? Yeah. Okay. Anything else going on in the markets? Did Russia invade any countries? Did Hezbollah, Hamas, blow up a mosque or something? Or they wouldn't do that. They blow up a church. But anything like that?
This is more so related to Saudi Arabia. There was a giant cyber attack on Aramak, and pretty much they just stole a bunch of data, and they're pretty much stuck up for 1 month until the data becomes useless in that period. Up until then, there's just a lot of uncertainty in oil from Saudi Arabia.
Great. So what's that going to do to oil supply?
They're probably not going to sell that much, so it's probably going to increase it.
Exactly. Exactly. That's what we're looking for. Okay. What's going on in the oil markets? Where's oil trading per barrel? Is it up or down, by how much and why?
Oil is trading at 72.33. It's down 6 cents at negative 0.08%, and that is due to.
Where does that, if the prices are dropping, what goes through your brain?
Surplus.
Yeah, either the supply side or
Demand side.
demand side. Is demand increasing or decreasing if prices are falling?
The prices are falling,
Decreasing. Exactly. Okay, so that's what that's the logic here. Okay, anything else in the oil markets?
The oil steadies after a near 2-week high as the U.S. stockpile is declining. So essentially, it's going to go back up or even higher.
They're going to have to buy some oil. They're drawing down the oil. Why are they drawing down the reserves, the inventories? What are they trying to do? Why are they dipping into their inventories?
Pretty much because supply is cut off and they're trying to level off.
Increase them, exactly, to try to keep the prices down. Okay. Is it fun to pay $5 a gallon for gasoline?
No.
No. And if you're paying $50 or $100 a gallon, $100 to fill up your car, then you're not going to have any money left, right, to buy the G.I. Joe with the Kung Fu grip for your kids for Christmas. So you got to be thinking about that. Where's gold trading per ounce?
gold is up
Now, don't be shy.
Oh,
You know, just yell it out. You know, these traders, they're in the pit, they scream, they yell, you know, they yell at people, they scream the trades. You know, that's what I love about New Yorkers. They got no problem yelling at people. So where's
It's
gold
up
trading?
58%.
Gold is up 58% from what time period to what and how much?
It went up $10.50, so right now it's at $1,810.20
So it's up $10 over what period of time?
over,
Over the last day, the last week, the last month, 2 months, year?
over the last few hours.
So it's up $10. Is that true? Could you guys confirm that?
Yeah.
Okay, what would be driving demand for gold?
Inflation, risk.
Higher inflation expectations, higher inflation. What was the CPI that was just reported on an annual basis? What did the prices go up at? Didn't we go over those notes? Did we go over that in class? Did we go through that lecture?
It says it's up 0.9%.
Yeah, what is it year over year? How much is inflation up? Do you care?
6.9.
What was it?
6.9.
Is it nearing 7.2?
I think that's about right. I think it was 5.4, but I think it was that high. Is that high?
6.8, yes.
Is that high? No?
It is high.
Well, if your wages aren't going up by that much, then your standard of living is going down by that amount. Is that fun? When you see your purchasing power drop by 7% year over year?
Yes.
Yeah, it's not fun. Inflation is probably the worst thing ever that could happen to anybody, okay, and a society. Okay. Just be glad we don't live in Venezuela. They had a 1 million percent.
Definitely see like hyperinflation.
Hyperinflation wiped out the middle class, wiped out the lower class, and basically caused the majority of people to basically scavenge through garbage dumps to basically have enough to eat. Total disaster. Okay. Where is the 10-year Treasury yielding right now? Is it up or down by how many basis points? The 10-year? Is it up or down? By how many basis points? What's the percentage? Where's it yielding right now? Is it high or low? Where do you think it's going to go?
It's up by 2.19%, so 219 basis points.
No, that's impossible. Because that means that the other day I looked at it, it was like 125 basis points at 1.25%. If it's up 200 basis points, that means that interest rates went from 1.25 to 3.5. That's impossible.
102.
The markets would crash. The stock market would have
Oh, I'm sorry.
collapsed.
I was looking at the wrong number. I'm sorry.
Okay. Gotta be careful. 'Cause when you're in the meeting with Charles Schwab, you know, Chuck is over at the other end of the table, you know, and you're saying that, you know, the 10-year Treasury is up 250 basis points, you know, he's gonna freak out. So where's the 10-year Treasury yielding again?
1.26.
1.26, is that low? Are 10-year interest rates low?
Yes.
Yeah.
Okay. You know, in the 80s, they were 20%. Now they're 1.2 something. And they almost got to 2% over the last 6 months. Okay, so what's the trend in the 10-year Treasury?
For the long term, or
Well, what's the trend? What's it been?
it's been at an all-time low, but it started to rise, and then it's going back down right now.
Yeah, so it's trending down. Is it trending down?
Yes.
Okay. And then what's causing the 10-year Treasury yield to fall?
Rising inflation rates.
How does that work? What's using the Fischer equation? What are the two components that basically determines nominal interest rates? What are the two components using the Fischer equation? Do you know? Can you look it up? Click, 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 click. Fischer equation, Investopedia. Oh.
Real
inflation rate or inflation expectations? Got it. So if the 10-year Treasury yield is trending down, what's driving down the yields? Based on the Fischer equation.
It's going down.
Thank you. Yes, inflation expectations. And if inflation expectations are going down, where the market is looking out into the future and thinks that inflation expectations are going to be falling, driving down the 10-year Treasury yield, what does that tell you about future economic activity? Yeah, is inflation expectations and economic activity correlated to each other positively? Do they move together?
Yes.
Yeah. So if the bond market, is the bond market big?
Huge.
Yeah, it's massive. I mean, we have like $23 trillion in debt outstanding. So just a U.S. sovereign bond market just for U.S. Treasuries is like $23 trillion. That's a huge market. So if inflation expectations are going down and economic activity is expected to go down, right? What's happening to the 10-year Treasury yield? It'll probably continue to do what?
Go down.
Go down. And what happens if short-term interest rates go up and long-term interest rates continue to go down? What happens to the yield curve?
It inverts.
It inverts. And when the yield curve inverts, what happens within 12 months? What happens within the first 12 months?
The economy peaks.
The economy or the,
Within 12 months?
within 12 months.
Uh,
Did we go over this?
Yeah.
Yeah, okay, so it's in your notes. So
Yeah.
within 12 months, what happens? If the yield curve flattens and inverts, what happens to the, what happens in the first 12 months? Did I do the dynamic yield curve for you guys? Went up to stockcharts.com and showed you and walked you through and lectured you on that? Did I do that?
Yeah.
Okay.
We're just looking for a note.
Okay, Joseph, Nadine, Danielle, what happens if the yield curve flattens and then inverts? What happens within 12 months?
I'm just trying to look back in my notes at the moment.
What happens within the first 12 months?
Doesn't the stock market like reach a peak? Yeah.
Thank you. Stock market peaks. And then what happens within 24 months?
Recession.
Got it. Okay. Write that down again. Memorize it, please. Because I'll tell you, when the yield curve inverted at the end of 2019, I had like 14 phone calls from my students. They were saying, Professor, as soon as the yield curve inverted, it's like, well, we're probably going into a recession within 24 months. What happened within 24 months?
A recession.
We went into a depression. I didn't forecast COVID, but I was already forecasting a recession. Okay, awesome. Where is the dollar to the pound, dollar to the euro? Where's the currency exchange rate? Jada, Joseph, Nadine, you guys can hide, but I know where you are.
The pound ended up today is at 1.39.
Okay, is it up or down?
Up
Okay, does it cost me more or less to buy a pound?
more.
Did the dollar appreciate or depreciate against the pound?
Depreciate.
Got it. And did the pound appreciate or depreciate against the dollar?
Depreciate.
Why would the dollar depreciate against the pound? What's going on in the UK, what's going on in the United States?
Delta variant.
Huh?
The Delta variant.
Okay, is it, if the dollar's depreciating against the pound, does the market perceive that it's gonna be worse in the United States than the UK? Or better, we're gonna weather it better than the UK?
Worse.
It's gonna be worse
In
in,
the US.
exactly, okay, excellent. What about, if the pound is appreciating against the dollar, what's the economic perception for economic growth of the UK compared to the US? Higher or lower? Higher. Okay, that's good. What about interest rates? If the pound is appreciating against the dollar, do people perceive that interest rates are going to be higher in the UK or lower in the United States? Are they going to be, is UK interest rates going to be higher than the US or lower than the US?
Higher.
Higher. Right? Because if interest rates are higher in the UK compared to the US, where are you going to invest your money?
When you get higher returns in the UK.
Higher interest rates, exactly. And what about potential stock market returns? If the pound is appreciating against the dollar, what does the market perceive about stock market returns in the UK compared to the US?
Higher in the UK.
They're going to be higher in the UK. Got it. And what about real estate values?
Go up in the UK.
UK compared to the United States, exactly. Okay. What about political stability? UK or US currently?
UK.
Probably UK, right? Because we're basket cases. What about, what else is out there?
Quality of life,
Huh?
quality of life.
Could be. Higher standards of living, potentially. Political stability. Lower inflation. Higher returns. Higher interest rates. Better prospects. What about the Biden bills?
What was that?
What about the Biden bills? Do political appropriations, bills, spending bills, budgets,
They,
do they have any effect on economic expectations?
yes.
Yeah, so what's going on with the Biden bills? We were at what, 2-3 trillion for an infrastructure bill, how much are we at now?
1 trillion.
Yeah, like 1 or less. Okay, so basically a half to, 2/3 less. Okay, so is that gonna have an impact on the economy? Yep, what about the budget? I think we're at what, 3.5 trillion? For a budget, for his budget? Is that big? Smaller? Same?
Well, it'll be smaller if it's only 1 trillion for the infrastructure.
No, well, that's infrastructure. I'm talking about his budget. What's the budget? Does the government have any effect on the economy whatsoever?
Yes.
Yes, of course. Isn't it one of the major components of GDP?
Yeah.
Yeah, okay. So if the government spends a lot, what happens to GDP?
Goes up.
It goes up. What if they spend, less?
Goes down.
It goes down. So you got the infrastructure bill, and you got the budget. How much is the budget?
About 6 trillion?
Isn't that big? I thought it was like 3.5.
6.8 trillion.
6.8 trillion for the budget.
3.8.
Or was that, wait, was
It's
that
outlays.
was that was proposed or
That's
decided?
awesome.
No, it hasn't been decided yet.
Okay, I think that was proposed numbers. But they're running a deficit of 1.3 trillion right now.
Yeah, but I thought it was 3.5. Maybe I'm wrong. Am I wrong? Is the Biden budget not 3.5 trillion? Is that a big number?
Well, it says that its proposed $6 trillion budget would be the highest ever.
Is that a lot?
Yeah.
Yeah.
Do you think that if the government spends too much money, it could create inflation?
Yeah.
Yeah. Do you think that if the government spends too much money and they have to issue bonds, and if nobody buys the bonds, the bond prices could go down and interest rates could go up, offsetting the stimulus effect?
Yeah.
Yeah. And then what happens if interest rates go too high too fast?
I thought
The
that
will slow down the economy and potentially send the economy into a,
I can't think of the word.
into a what? Into a recession.
That's the word.
Recession, not regression. Okay, where's the dollar to the pound, dollar to the euro? That's okay, I'm just trying, this is a crash course, right? You don't have me for, 3 months, you only have me for 5 weeks.
So it's trading, $1 gets $1.18 per euro.
Okay, up or down?
The dollar,
Is it gonna cost, is it costing us more or less?
it's costing us less.
Okay, can somebody confirm that? Because usually, when the dollar to the pound, dollar to the euro is highly correlated with each other.
It's up according to this, but it's moving really rapidly between up and down, so it's.
So there's high volatility?
Yeah,
Okay. And what's it trading at right now?
1.18.
1.18, where was it?
It opened at 1.18.
Yeah, but where was it, like at the beginning of the week or 2 weeks ago or a month ago? What was it?
July 29, 1:26 a.m. UTS.
How much?
1.18.
1.18, and how much is it now?
Same.
1.18, any trend?
From Friday to today, I think it's trending up.
Okay, so the dollar's doing what?
The dollar is losing value again.
Yeah, it's depreciating, okay. Is that a problem?
Yes.
If the dollar depreciates and the foreign currencies appreciate and we import more than we export, what's gonna happen to import prices?
More expensive.
They're gonna be more expensive. And if we're importing more expensive goods, what happens to inflation?
Goes up.
Goes up. Are you better off or worse off?
Worse.
Worse off. And if the Federal Reserve starts to taper and stop buying the bonds, what's gonna happen to bond prices?
They're gonna go down.
They're gonna go down and interest rates are gonna go up. You think people are scared of that?
Yes.
Yeah, totally. That's what they wanna know, is when are they gonna start raising interest rates? And what did he say? What did Powell say?
Not yet.
When did he say to expect at least a couple rate increases?
Beginning of 2021, that's the one.
No, when did he say he was gonna start tapering and potentially raise short-term interest rates? Is he gonna do it in the second half of this year?
Before the end of 2021.
So maybe one rate increase by the end of the year? Okay, and then what about next year? If they increase interest rates once, what's the probability that they'll do it again?
A lot higher.
A lot higher. And what if they do it 2 times?
Then you see a trend.
Yeah, they'll probably start raising interest rates. And in the past, what they've done is they raise interest rates and then they get on a rate path. You start increasing rates. Okay? And that's when things start to get shaky, and when it inverts, see you guys, we're going into a recession. Okay, awesome. Okay, and where did we leave off on the midterm? No, we didn't. Did we finish the midterm, is what you're telling me? Did we do yield curves?
No, I think we stopped there.
We stopped at CAPM.
The capital loss and pricing model?
Yes.
That's, no, but did we do macro foundations, unorthodox monetary policy, did we do yield curves?
We were on macroeconomic foundation.
Okay, did we end on who's gonna benefit and who's gonna get hurt by negative interest rates?
We got past that.
You guys can help me out a little bit here. You guys on Zoom, you can help us out a little bit, please. Where did we leave off?
Yeah, we finished the B.
Okay, cool. So we're doing yield curves?
Yeah.
Okay, awesome. What was the Fischer equation?
Nominal interest rate.
Nominal interest rates, okay, is equal to what?
Real interest rate
Real rate?
plus inflation expectation.
Got it. Plus inflation expectations, excellent. Do the real rates move up and down a lot? On a daily basis?
Yes.
Do real rates change every second of the day? Or are they more cyclical, secular?
Cyclical.
Cyclical and secular. So if they don't move every single day, would that be considered a constant?
Yes.
So where does movement in nominal interest rates come from?
Inflation expectation.
Exactly, and if inflation expectations are going up, what happens to nominal interest rates?
Up.
They go up. And what if they go down?
Down.
They go down. Got it. Is inflation and inflation expectations highly correlated to overall economic activity?
Yes.
Yes.
Okay, and if you're seeing inflation expectations go down, what does that tell you about future economic activity?
Goes down.
Exactly. Okay, and what's happening to inflation expectations if unemployment rates are rising? So unemployment is going up, what happens to economic activity and inflation expectations?
Slows down.
They go down. Got it. And what about if unemployment drops below 4 or 5% and goes to 3%? What does that tell you about the labor market?
It's doing well.
Yeah, we kind of went all over this. Okay. I'm looking for technical terms. At 3%, what's it called? What kind of unemployment is it? What's the natural rate of unemployment?
Between 4 and 5.
Between 4 and 5%. So if the inflation rate, if the unemployment rate goes to 3%, what's that called?
Natural.
The natural rate is between 4 and 5%. If unemployment goes to 3, it's called what?
Non-natural.
Huh?
Is that non-natural?
No. No.
What's the question again? Sorry.
If the unemployment rate drops below the natural rate of 4 to 5% to 3%, what's that called? What kind of unemployment is that? What kind of unemployment rate is it? Okay, would that be considered full employment?
No.
Okay, at 3%.
Underemployment?
Underemployment would be 15%. So at 3%, what is that? Is that low?
Yes.
Yes. Would that be considered frictional? You got a 50-50 chance of being right by saying something. Okay, so it's frictional. So are we at full employment?
No.
What is
How's that work?
What does frictional mean in this sense?
It means that anybody who can basically get a job is employed.
Oh.
So it's considered full employment.
Well,
So at a 3% unemployment rate, what is your forecast for inflation expectation? Going up or going down?
Going up.
Going up. So if there's frictional unemployment, what does that tell you about the labor market? Is it tight or is it loose?
Tight.
It's tight. So are employers going to have to bid up wages?
Yes.
Yes.
Yes. And if they bid up wages and they give workers more money, what do they do with that money?
Spend
Spend
it.
it.
They spend it, and if they're buying goods, what does that do to goods prices?
Goes up.
Goes up. What does it do to inflation expectation? And what happens to interest rates?
Go up.
Okay? All right? So I'm just testing you over and over again on this stuff. Okay? All right.
What was the answer to interest rates there?
When the unemployment rate falls below the natural rate of 4 to 5% to frictional of 3%, my question was, what happens to, at full employment, what happens to wages?
They're gonna have to go up,
They go up. And what do people do when they have more money?
buy more goods.
They buy more goods. And what happens to inflation and inflation expectations?
that goes up as well,
And then what happens to interest rates?
that goes down.
Well, how's that work? If
Oh,
there's
sorry.
if there's a positive correlation between inflation
They
expectations,
both go up together.
and if interest rates go up, what happens to bond prices? They go down, okay? So it's all related, right? It's all logic, all right? So, using the Fischer equation, what variables drive the risk-free rate or nominal interest rate on US Treasury securities by maturity up and down? Inflation expectations. What shifts the yield curve up and down, flattens and inverts it? Can you guess? What moves the yield curve?
Inflation expectation.
Inflation expectations, exactly. Okay. So the yield curve looks like this. So this is the maturity on the bond. Okay. The US government issues bonds by maturity. 3 months, 6 months, 3 months, 6 months, 9 months, 1 year, 3 year, 5 years, 7 years, 10 years, 20 years, 30 years, and you can go to Europe and they issue 50 and 100-year bonds. Okay? And at each maturity, there is a corresponding interest rate, or nominal interest rate, or what is also called the yield to maturity on bonds. Got it. Now this yield curve that we're looking at is called an upward sloping yield curve. It's also called a normal. It's called the normal yield curve. And when you see an upward sloping normal yield curve, what does that tell you about inflation expectations? Are they positive, zero, or negative?
Positive.
Positive. And what does that tell you about future economic activity? Yeah, positive. So when you have an upward sloping yield curve with positive inflation expectations, are you anticipating a recession? When the yield curve is normal, upward sloping, and the market thinks that inflation expectations are going to be positive, is the market anticipating a recession?
Yeah.
Yeah.
How's that work when you have positive inflation expectations? Are inflation expectations positively or negatively correlated with economic activity?
Positively.
Positive. So people think that inflation expectations are going to be higher in the future. What does that tell you about future economic growth? Positive. So when you see a normal upward sloping yield curve, what is the market telling you about future economic activity? Positive. Got it. Okay, excellent. All right. And if inflation expectations increase for all of the bonds across the yield curve at all maturities, what's driving the shift in the yield curve? What would cause the yield curve to shift up?
Inflation expectations.
Higher inflation expectations, exactly. And what would cause the yield curve to shift down?
Negative inflation expectations.
Yeah, or lower inflation expectations, exactly. And do yield curves shift up and down
Yes.
over time? Yeah, the yield curve is totally dynamic. It's shifting every day, every second of the day. Okay. These are interest rates for each of those maturities. And you can go up to the Federal Reserve Bank Board of Governors website, and they'll give you the yield curve, you know, the data going back in time, basically like since 1913 when the Fed was invented. Okay. Got it. So it's inflation expectations that are going to move the yield curve up and down, flatten it, and invert it. Okay. So if the yield curve, let's say, starts to flattened, so it goes from normal to flat, what does that tell you about inflation expectations on the short end of the yield curve? The yield curve is flattening. What does that tell you about inflation expectations here on the short end of the yield curve for the short maturities?
Inflation expectation will go up.
Inflation expectations are rising in the short term. Okay? And what if the yield curve inverts like that? What does that tell you about inflation and inflation expectations in the short run and in the long run? Is economic activity higher in the short run or higher in the long run when you have an inverted curve?
In the short run.
It's in the short run, right? Higher inflation expectations. Okay? And then what do they think is going to happen to the economy in the future? Well, you know, it's going to decelerate, or inflation's going to go down, or maybe a recession. Okay? And actually, when the yield curve is flat, the inflation expectations are 0, and when the curve's inverted, the inflation expectations are negative. Okay? So the #1 predictor. So everybody's watching it, although I'm shocked that more people don't even follow this stuff. Yes? You had a question?
Oh, no, I was just like, thinking my hand.
Oh, okay. Okay, cool. Show the equation and graphical representation for an upward sloping curve. Boom. A flat one inverted, an inverted curve. What are the 3 yield curve theories? Haven't done this before. Oh, okay. So the next. Okay, what kind of yield curve is that?
Upward sloping.
Upward sloping normal. What is, how do you calculate nominal interest rate using the Fischer equation?
The no.
How do you calculate nominal interest rates using the Fischer equation?
The real rate plus inflation expectation.
Inflation expectations.
I gotcha. Okay. Are the inflation expectations positive, 0, or negative?
Positive.
Under a flat curve, what are inflation expectations? 0. And under 0 inflation expectations, what is the nominal interest rate? It's the real rate. Okay. And then what kind of curve? This is flat. And what kind of curve is this? Inverted.
Professor, what was the value for the nominal interest rate on this flat one?
0. Inflation expectations are 0 when the yield curve is flat. And inflation expectations are negative when the yield curve is inverted. Okay? Got it. And there are actually 4 yield curve theories. expectations hypothesis. And basically the expectations hypothesis is the Fischer equation. Which basically states that movements in the yield curve are due to changes in inflation expectations. Okay, the second theory is called the preferred habitat. The third one is called market segmentation. And the fourth one is called liquidity preference. Okay. And these are all actually related to each other.
No.
Okay. So it basically says that the bond market is segmented. Okay. So if this is the bond market, we have short-term maturity bonds, we have medium-term maturity bonds, and we have long-term maturity bonds. So the market is segmented by maturity. Okay. Short-term is probably 1 to 3 years. Medium-term is probably 5 to 7, and then the long-term is 10 to 30-year maturities. So there's different supply-demand dynamics going on in the different market segments for the bond market by maturity. The preferred habitat basically states that individual investors and institutional investors prefer to borrow and lend in different segments of the bond market. Corporations like to be down here. They love to borrow at the short end of the term structure because they can lower their cost of capital. Okay? Pension funds, on the other hand, like to buy long-term bonds because they want to have assets with long-term maturities that match the long-term liabilities when the pensioners start to claim their pensions. So they can match, based on the actuarial tables, they can buy the bonds and match the maturities of when they're going to need the money to start paying out the pensioners in the future. So institutions like to be here, corporations like to be here. Liquidity preference basically states that, let's say I have some money and I don't need it for 5 years. So I can buy a 5-year bond. I'll get the coupon interest payments biannually over time, so I'll make a little income. And then at the end of the 5 years, I'll get my principal back. Okay? So I don't need the money for 5 years. So my preference is I want the liquidity when I need it, when I prefer it. Okay? So people who, want liquidity within a very short period of time are going to buy short-term bonds. This is where the majority of the demand is, okay, and supply of bonds is on the short end of the term structure. It's called the term structure, and it's also called the yield curve. Okay, and that's how we talk, on the short end of the term structure, on the short end of the yield curve, okay, as opposed to the long end of the curve, or the long end of the yield curve.
Just a side question, why when we're looking at bond prices do we look at the 10-year treasury?
The 10-year treasury, because it takes into consideration inflation expectations because it's so far out. That Alan Greenspan, who was the chairman of the Federal Reserve for 2 terms, basically said, if you want to follow any one interest rate, look at the 10-year treasury, okay? Because it includes, it's a risk-free rate for one, it includes the real return, but really it adds on an inflation risk premium. Okay? So if I'm an investor or a lender, and I want to lend corporations or I want to lend the government my money, I want to get the real rate plus some compensation for the deterioration in purchasing power from my coupon payment and my principal to compensate me for inflation. Because the coupon payment is fixed, the principal that I get is fixed. So the problem with inflation for bondholders is it deteriorates the purchasing power of your coupon payments and the value of the principal at the end of the maturity, at the end of the term. Okay? All right. So the 10-year includes the inflation expectations, and the 10-year is the benchmark interest rate. Okay? Student loans, mortgages, business loans, you name it, are priced off of the 10-year Treasury. Okay? And then the banks start tacking on additional risk premiums based on your credit, based on the collateral, based on the maturity time period, based on the liquidity of the bond or the loan if they want to resell it. So they start tacking on higher components until they get to a market interest rate. So look at your credit cards, right? The banks are borrowing at 0, right? You deposit at the bank and they're paying you what? 0.25%, but they're charging you what? 17? 24. So let's say they pay you 1% on your deposit and you lend it out at 16 percentage points. That's all profit for those guys. Right? There's some expenses in there, but they're making a lot of money. So people ask me all the time, Larry, what should I invest in? Invest in bank stocks. They're basically monopolies, particularly the top 5 banks. Who oversees the banking industry?
Nobody really.
No, who prints money for them?
Oh, the Treasury.
No, not the Treasury. Who? Huh?
The people.
No, come on, we've been talking about it all class. What financial institution oversees the banking industry
Congress?
and creates money?
Federal
Fed?
Reserve.
Yeah, the Fed. Can the Fed print money?
Yes.
Yeah. Can the Fed buy bank bonds and government bonds and inject liquidity into the system and drive interest rates lower?
Yeah.
Create the interest margin and spread for the banks and the profitability? Can they bail out the banks?
Yeah.
Can the Federal Reserve bail out the banks?
Yes.
Yeah. Any other industry get bailed out all the time?
Corporations?
Do they all?
Not all, but some.
Not all of them, but what about the bigger banks?
No.
Did they get bailed out? Did they get bailed out?
Yes.
Did the Fed bail them out?
Yeah.
Who runs the Federal Reserve System? Who oversees it?
Congress?
No, who sits on the Board of Governors? Who sits on the Board of Governors of the 12 regional banks?
The chairman.
Yeah, but who are those people? And they're mostly guys. Who are they? Can you guess?
Are they like corporate executives?
Probably bank.
Not corporate.
Bank.
Banks. Bank executives. So who runs the Federal Reserve?
Bank.
The banks.
Same.
And if the banks run the Federal Reserve, and the Federal Reserve has a monopoly on currency and printing money, is that a monopoly?
Yeah.
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 So would you be buying bank stocks?
Yeah.
Yeah, because they're monopolies.
They also make a lot of money on late fees. I heard
Yeah.
like a huge amount of
Totally.
money yearly.
Yeah. Yeah. Microsoft, Amazon, Google, our Alphabet, are those guys monopolies?
Yeah.
Yeah, are they gonna be around
Yes.
forever?
Probably.
Yeah.
Would they be a good investment for the long run?
Yeah.
Yeah. What about the top 5 banks?
Yeah.
How long have the top 5 banks been around?
100+ years.
Yeah, exactly. You think they're gonna be around another 100?
Yeah.
Probably.
Yeah. It's kind of a no-brainer if you want, everybody asks me, it's like, what should I be investing in? Just look at the companies that you think are gonna be around forever and thrive and invest in those. Because you guys are probably gonna live until you're 120.
Yeah.
No, I'm serious. You guys would probably live another 100 years.
Not if we party the way you do.
Exactly. Yeah. Okay. Excellent. So these are the theories. And that's what we look at constantly. What impact do movements and shifts in the yield curve have on asset prices? Okay, that's a good one.
Can you repeat the question?
Yeah. So what do movements and shifts in the yield curve have the impact have on asset prices? Okay, so let's look at the yield curve again. And let's say that the yield curve shifts up. What happens to interest rates?
They go up.
Interest rates go up. Got it. And if I am pricing a bond, and this is the coupon bond payment, what happens to the value of the bond when interest rates go up?
It's less
It goes
valuable.
down. Got it. Bond prices go down. What happens if the yield curve shifts down? And interest rates go down. What happens to the value of the bond? Goes what? Goes up. So upward shifts in the yield curve cause bond prices to go down. And downward shifts in the yield curve cause bond prices to go up. Got it. What about real estate? So we take net operating income and we divide it by the cap rate, which is called the capitalization rate. Okay. And we know for government bonds that the Fischer equation determines nominal interest rates. Okay. And actually this is called the risk-free rate. And when you're looking at cap rates, the cap rate is the risk-free rate plus all of these risk premiums, like the location of the property, the quality of the building, the quality of the tenants. All of these factors are put in there. So if interest rates go up, what happens to the cap rate?
Goes up.
Goes up. And if the cap rate goes up, what happens to the value of the real estate?
Goes down.
Goes down. Got it. And if interest rates go down, what happens to the cap rate? Goes down. And if the cap rate goes down, what happens to the value of real estate?
Goes up.
Goes up. Got it. Excellent. And what about earnings per share? For a company next year? Trying to value the stock price. Okay, and I'm going to use the constant growth model or the Gordon growth model here. Okay, and I'm going to hold the growth rate expectations, the constant growth rate in the earnings per share forever, growing out at a constant rate. I'm going to make it a constant. And this discount rate, these are all discount rates. This discount rate is the expected return on the equity. So this is the expected return on the investor. I'm investing in a stock. I forecasted the earnings per share out next year for Apple. Okay. my expected return for investing in this kind of company is it could be at least 10%, because that's what the stock market has done over the last 10 years. So I could use as my discount rate or my expected return the long-term return on the S&P 500, which has been between 8 and 10% over 20 years. I could do that. I could do that. That could be one way. The other way is I could calculate the expected return on the equity by using the capital asset pricing model, okay, which hopefully you guys already know what that is. That's basically the standard equation used to calculate the expected return on the equity or the cost of the equity for a company. Okay, does anybody know what the capital asset pricing model is? Click, 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 click. Capital asset pricing model, bing, Investopedia, blam, right in your face. So what's the capital asset pricing model? Or what is also called CAPM. And you guys should be looking this stuff up too. You know, I haven't heard from you guys. You guys are quiet as a mouse.
The test is the relationship between systematic risk.
Got it. What's the equation?
It is ER little I.
Okay, that's the expected return.
Is RF.
Risk-free rate. Got it.
Plus beta.
Plus the beta. This is the regression coefficient, because we're going to regress the returns on the market, on the stock, and get the beta. Okay. Times what?
Times ER little m.
Okay, so that's the expected return on the market.
Minus R little f.
On the market. Minus the risk-free rate. Got it. And this is the market risk premium. Okay. Did you guys get this stuff in your finance class? No?
No.
Did you take it? Did you take it? And they didn't teach you on CAPM? Oh, horrific. Okay. So test question. If the risk-free rate goes up, what happens to the expected return on the equity?
Goes up.
Goes up. And what happens to the value of the stocks?
Goes down.
Goes down. And what if the risk-free rate goes down? What happens to the expected return on the equity?
Goes down.
Goes down. And if the discount rate goes down, what happens to the value of stocks?
Goes up.
Goes up. Got it. Okay. Excellent. How does the Federal Reserve influence interest rates? What policy tool do they use to move interest rates? What is the objective of buying and selling bonds? Okay. Let's see. Did everybody get this? Okay.
Yes.
Okay, thank you. So let's go back to the yield curve. Okay, and I'm going to use an upward sloping curve. The Federal Reserve manipulates interest rates by buying and selling bonds through open market operations. Open market operations, okay, where they buy and sell bonds in the open market through the Federal Reserve Bank of New York. Called Federal Open Market Operation. This is a monetary policy tool. Now, the Federal Reserve has other monetary policy tools like reserve requirements. They can lower them and inject a bunch of liquidity in the system, or raise the reserve requirement and pull money out of the system. They offer discounts on loans through what is called the discount window, but those two policy tools are rarely used, okay? It's open market operations where they actually go into the bond market and buy and sell bonds, okay? Now, if the Fed buys bonds, what happens to bond prices?
They go up.
Bond prices go up. Got it? And when bond prices go up, what happens to interest rates?
They go
They
down.
go down. Excellent. And when they sell bonds, what happens to bond prices? They go down. And interest rates go up. Got it. That's what the Fed does. Just buys and sells bonds, enters the bond market. When they buy bonds, it drives up bond prices and drives down interest rates. And when they drive down interest rates, does that stimulate or cool the economy? Stimulates it. Okay. And when they sell bonds, bond prices go down and interest rates go up. Does that stimulate or cool the economy?
Cool.
Cools the economy. Got it. So we're watching the Fed every single day. Okay. What policy tool do they use to move interest rates? Open market operations. What is the objective of buying and selling bonds? Moving bond prices up to drive interest rates down to stimulate the economy, or sell bonds to drive bond prices down and interest rates up to cool the economy. Got it. If the Fed buys and sells bonds, what is the impact on bond prices? I just answered that. What is the impact on the interest rates? I just answered that. Does the Fed control and influence directly short-term or long-term interest rates, or both? Okay. This is the tricky question. So the Federal Reserve directly controls short-term interest rates. Directly. So this is where they come in, okay, on the short end. They don't directly influence medium term, even though they do to a certain degree. The theory is that they directly control short-term interest rates by buying and selling short-term securities. Got it. They're indirectly influence long-term interest rates. Got it. So the question becomes, can the Fed impact long-term interest rates?
Yes.
Yeah. And what would they do? If the Fed thinks that inflation is getting out of control, what are they going to do? Buy or sell bonds? Inflation is out of control.
So,
They're going to sell bonds. And what's going to happen to bond prices?
They're gonna go down.
They're going to go down and interest rates are going to go up. Got it. And that's probably going to flatten the curve, right?
Yes.
Yep. And what if the Fed sells too many short-term securities, driving short-term bond prices really low and short-term interest rates really high? What happens to the curve?
Inverts.
It inverts. And did the Fed have an impact on long-term interest rates, driving them down? Yeah. And why are interest rates, short-term interest rates, higher than long-term interest rates? What do people think about inflation expectations in the short term and the long term? If you see an inverted curve, what do they think is going to happen in the future? A recession. Exactly. So if the Fed raises short-term interest rates high and fast and inverts the curve, are they going to have an impact on long-term interest rates? Yeah. So the Fed has a direct impact on short-term interest rates, but an indirect impact on long-term interest rates. But they do influence them. Okay? So who's in control?
The Fed.
Who controls the economy?
The Fed.
The Fed, right? Not Apple, it's not Google, it's not the Treasury, it's the Federal Reserve, okay? That's why we spend so much time on this. All right. Now the next question if you go to Google and you type in dynamic yield curve and you click on it, you're going to get this website. And if you go up right here to the dynamic yield curve tool, you're going to be able to pull up not only the S&P 500, here's the, all right, there we go. Okay, so here's the yield curve right here. What kind of curve is that?
Upward.
Upward
Normal.
sloping, normal. Got it. What does that tell you about future inflation expectations?
Positive?
Positive. So when you see this, do you think we're going into a recession?
No.
Okay. Is the yield curve, even though it's upward sloping, are interest rates low across the curve?
No.
Yeah. I mean, what's the 10-year Treasury? What is it, like 1.2 something? Right? And the 30-year, the 20-year and the 30-year aren't even probably at 2%. Here's the S&P 500. Here's where we are now. So what's been happening since 2008?
Been surging up.
It's pretty much straight up, isn't it? Except for a couple of these hiccups here. So don't you wish you would have bought in here, right there? Or maybe bought, you know, right here, last year?
So whenever there's a recession, we should buy?
Yeah. Buy the best companies. It's buying opportunities. I was trying to get my business partner to buy $25 million worth of securities. Johnson & Johnson, Procter & Gamble, Pfizer, Apple, Microsoft, Alphabet, right? All the best companies.
Who was this? Like what time frame?
Last year,
Oh.
like in March, when the market crashed. Because we knew the Federal Reserve and the Treasury were going to step in and prop up the system. So it was a great buying opportunity.
Is that always the case?
Huh?
Is that always true that they'll try to prop it?
Yep. Yep. I mean, they're running out of bullets, right? Because they got 23 trillion on the Fed, on the Treasury side of the balance sheet, and the Fed's balance sheet is how big now?
What, that's supposed to be 6?
It's like 8 trillion going to 9. So the question is, how far can the debt levels go, and how far can the Fed's balance sheet go? Is there a limit? That's been our question. I don't know, you guys gotta figure it out, I can't figure it out. Okay. So check this out, so I'm gonna hit, let's just, because when you hit the animate right here, it's gonna reset the whole thing. And what you're gonna see first is we're gonna come back here, and I don't know if you guys remember, but what was happening in like 97, 98, 99, 2000, does anybody remember?
The housing crash?
No, what?
The housing crash?
No. In 1997, 98, 99, 2000.
The economy was booming.
It's booming. What was going on?
The dot-com.
Yeah, the dot-com bubble was surging, right? Things, I mean, we were partying in the city every freaking night. I'm serious. There was startup company. I mean, I went and saw James Brown at the Warfield. You know, for a
Was that for your
startup
birthday?
company, they totally flamed out and went bankrupt. They threw some of the greatest parties. No, it was crazy back then. And then, you know, dot-com bust hit, then 9/11 hit, sent us into a recession. Then we came out of it, we went into the housing boom, housing bust, financial crisis. Came out of that, right? And then, you know, had a little hiccup in 16, had the pandemic here. And then where are we going? Can the stock market go up forever?
Maybe.
I don't know. I mean, people think the Federal Reserve can continue to print money forever. We'll see. But here's the interesting thing. You click on the animate button.
Yeah, people find it confusing.
It never works when you want it to work. So are interest rates high leading up to the boom period, the
Yes.
dot-com boom? Tell me when the yield curve inverts. Is the yield curve shifting up?
Yeah.
What's happening to inflation expectations?
You're going up.
They're going up. And look, right before the peak, tell me when the yield curve inverts.
No.
Boom.
No.
Right there. Once it inverted, look, it's telling you you're gonna be in a recession within 2 years. So when it does that, it's predicting. What's the Fed doing right now?
Selling,
Are they buying or selling bonds?
selling bonds.
Okay, are they buying or selling bonds?
Fine.
They're buying bonds, driving interest rates
Down.
down. Okay, is that a normal curve?
Yes.
Yeah.
Yep. Is the Federal Reserve printing money and buying bonds, driving up bond prices to drive down short-term interest rates to stimulate the economy, to
Yeah.
keep it from crashing through the bottom?
Yes.
Yeah. Do people own a lot of stock
Yes.
in their 401ks?
Yeah.
And if it keeps going, how do you feel?
Right. Crap.
Horrible, right? Do you spend when your stock portfolio is down 30–40%?
No.
No. So what's the Fed doing?
Buying.
Buying bonds and
Increasing interest rates.
are they increasing? Well, now look what's happening. Is the Fed buying or selling bonds?
So.
Selling bonds, driving up interest rates because what's happening?
It's
Where are we in the business cycle?
going up.
Are we in the growth phase? Are we approaching the peak?
Growth.
Yeah, and what are they doing? When does the curve invert? Tell me when it inverts.
Right there.
A year before the stock market peaked. Okay? And then it inverts, says we're going into a recession within, you know, basically within 2 years. And then watch what happens. Once we start going off, this is the financial crisis. Okay? That was a cliff. And then watch what the Fed does. Boom. Before the interest rates were up in here, back here, this time around, they drove them to zero. Okay?
So
Never been done before. In Europe, they went negative. In Asia, they went negative. So the Fed just pegged the interest rates to zero. The yield curve was extremely steep. And then what you'll watch is as we start moving into this, they're gonna start buying bonds, driving down the long end of the yield curve. Pushing out the recovery, pushing out the stock market bubble. And right here, by 2013, we had already breached, this is the resistance line right here, you can see, right, the last two were basically the same, resistance, support. Now it's gonna break through that resistance line. Usually it would go up and bounce along, that resistance would become a support. This time around, it just kept going. It looks like it did a little right here, a little formation right there. That's called an accumulation consolidation right here. And then you're back off to the races again. And look at where the interest rates are. Short-term interest rates are pegged at zero. And then tell me when the yield curve starts to go up. And tell me when it flattens, and tell me when it inverts. This was years, right? Pegging interest rates at 0. Looks like we have a little pulse.
They're going up.
Looks like it's starting to go up in what year?
2016.
2016, 2017. Look how low the yield curve is, how shallow it is. Looks like it's shifting up now. Looks like short-term interest rates are starting to rise. Is the curve flattening?
Yeah.
Yeah. Starting to flatten. Even though interest rates are still extremely low. They were up here in prior recessions, or prior cycles. Looks like it's starting to creep up. Tell me when it inverts.
It's flattening there.
It's flattening. It inverts like right in the middle of 2019. Bam, right there. So it inverts right there. And so it basically means the stock market would have peaked within a year and we would have been in a recession within 2 years. And then the pandemic hits. And look how low the interest rates are. Drove down interest rates both along the curve, all the way along the long end, to historical levels. I think that the 10-year got down to like 1 or 0.8, in here. So where's the stock market going? The Federal Reserve is going to peg interest rates at 0. Is that going to continue to drive the stock market up?
Yes.
Yes.
For how long? I mean, the Federal Reserve is notorious historically, unless something changed, that they usually will pop asset price bubbles before they get out of control into massive speculation. This is unprecedented. Okay. I don't know about you guys, if you've ever studied Japanese history or Shanghai or speculation in other parts of the world. These asset price bubbles get out of control, and then usually the central banks will step in, pop the bubble, and then they go into a stagnation for like 10, 20 years. Because it takes that long to unwind, all of that speculation and asset price bubbles, and it just impacts the banking industry, right? Because they're sitting on all these inflated assets that then get written down. So they just hoard money and they don't lend out. They try to preserve their balance sheets. So I don't know about you, I thought that was pretty interesting. Okay, and that answers that question. What were your overall observations of the relationship and correlation between the yield curve and the S&P 500? There's a positive relationship. Right? As the economy starts to overheat, interest rates start to move up. Prior to the peaks, at least 12 months, the yield curve inverts. The stock market peaks within 12, and you're in a recession within 24, every single time. And you can go back post-World War II, and some economists have gone back prior to World War II, and they've gone back like 150 years, piecing back the yield curve, and it's the same phenomena. So the yield curve has like a 90% probability of predicting stock market peaks and recessions. Did the yield curve lead or lag the peak in the market? It led. If it did, by how many months? 12. Did the yield curve flatten or invert? Well, it flattened, then it inverted prior to the peak. On the short end or the long end? The short end. Can you use the yield curve to predict the stock market peaks? Yes. Recessions? Yes. By how many months? 12 and 24. Okay, that's it. Any questions on that?
You said 12 and 24.
Say that again?
You said 12 and 24, right?
Yeah, 12 and 24. When the yield curve inverts, stock markets peak within 12 months and you're in a recession within 24. 90% of the time.
Is there anything in the yield curve that tell you like when the peak will be within the next 12 months?
No.
No.
No, this is, and I've gone back and looked at some of the research too. But this is a clean theory.
So you just know that it will 90% of the time happen within 12 months. So you just don't know if it's going to
Yeah, so if the yield curve inverts, you got like 12 months to reposition your portfolio.
Okay.
You know, or put in some, you know, write some futures contracts or buy some puts or write some calls if you can afford to do that. Stuff when you're willing to take it. Or you reposition your portfolio. You get out of speculative tech and you get into more defensive stocks that are going to weather the downturn. I mean, you can do it. Go ahead.
So is the part about leading the peak, is that because you see the signs in the yield curve before it's reflected in the S&P?
When the yield curve, the short-term rates are higher than the long-term rates, it makes borrowing for corporations extremely expensive because they borrow more on the short end than they do on the medium and the long term. So their cost of capital goes up significantly, and that pinches them. So it drives up their cost of capital and then pinches the corporations.
Okay, thank you.
And the Fed steps in the recession, drives down interest rates to zero on the short end, and makes it extremely cheap for banks and corporations to borrow. Okay? And unfortunately, we don't benefit from extremely low interest rates because we're still paying 14, 18% on revolving credit lines on our credit cards. The banks are just pocketing that as profit margin. It's unfortunate. You know, why should corporations get to borrow at basically nothing when we have to pay 14% to 18% on our credit cards? It's usury, okay? It shouldn't be legal, but it is. Because who controls the banking system? The Federal Reserve, right? And who is the #1 beneficiary of political donations, lobbying, and PAC money?
Thanks.
Yeah, who's the major contributors? Banks. To whom? Who are they paying all that money to? Yeah, Congress, right? So if you're getting, you know, millions of dollars for your re-election campaign from the major banks, are you going to be passing legislation, usury legislation? No. No. Political corruption. Okay. Let's do the next, which is the bond market. I mean the markets. And I think some of you already did this. Did you already do? Yeah, you already did this. Some of the students already went through the notes that I posted on the class, and they're done with the midterm. So this is all just, you know, details that they're adding to the whole thing. Okay. All right. So let's do this. This is going to be the asset class. Okay. This is going to be the level. This is going to be the direction. This is going to be the change. And these are going to be the comments. Got it. And we're looking at stocks. We're looking at oil. We're looking at gold. We're looking at bonds. And we're looking at US dollar against foreign currency. Okay. So where is the Dow Jones Industrial Average today? No, give me the level.
34,800.
This is the test if you're tracking the markets. What is it?
34,831.
831, and we're going to do the Dow. Got it. And what's it been trending, up or down?
Up.
It's been trending up. Okay. And then do you have any numbers on, you know, percentage or points that it's been going up over some period of time?
In the last 6 months, it went up 4,948 or 16.5%.
4,000 points?
No, 4,948, so.
Okay, well, let's just say 4,000 points. Just-
Yeah,
And then what was the percentage?
it went up 16.5% last year.
16.5%, got it. And can you give me some comments on what's been driving the, we already talked a lot about it. What's been driving the stock market up?
Inflation?
Well, inflation does have some impact on earnings, right? Because prices are going up and revenues are going up, and they can keep costs down and their margins increase.
The economy's opened back up after.
You got economic growth,
Lower interest rate,
huh?
lower interest rate.
Yeah. Low interest rates. And when the economy's growing, what's happening to sales and revenue?
Increasing.
Going up. And what about earnings? It's going up. And if earnings are going up, what's happening to stock prices?
Oh.
They're going up. Okay, got it. All right, and then what's happening to oil? Where's oil trading?
Crude oil right now is trading at $72.37 a barrel.
Okay, $72 per barrel. Has been trending up or down?
In the last 6 months, it has been trending up.
Okay, do we have any, total dollar amounts or percentage changes?
Let's see, 6 months ago, it went from $52 a barrel, and now it is resting at about 72.
So 52, 70, so 20 bucks?
Yeah, $20.
And do you have a percentage change on that?
That one I don't, it didn't show.
Can you calculate the percentage change? Do you guys know how to calculate percentage changes? Do you know how to calculate a percentage change? Do you know how to calculate I'm just gonna ask the question until I get the answer.
Yes.
Okay, I got one yes and I've already seen two no's.
Can't remember.
Okay. Are you gonna be asked to do percentage changes?
Yes.
Yeah.
Okay, all right. So, where was it?
It was at 52, went up to 70, I found.
So 72 minus 52,
Yeah,
what's that?
so it was 20,
$20?
Yeah, I'll just do the percentage right now.
And what's $20 divided by 52?
0.38.
0.38. And what's the percentage change? 38%. Got it. All right. That's just one way of calculating a percentage change. You're an analyst when you can calculate percentage change. Since the beginning of the year, comma, since January 2021, comma, oil prices rose from $52 per barrel to $72 per barrel, comma, up $20, comma, or 38%, period. Okay, now you're an analyst, because that's all we do. Okay, 38%, got it. Okay, what are the factors driving oil prices up?
Demand increase.
Yeah, global economic demand. Okay, what else?
Scarcity.
Yeah, can you be more specific?
Issues with OPEC and Saudi Arabia pretty much.
Got it. OPEC. Production cuts. Okay, excellent. Where's gold trading?
1,813.
813. Is it trending up or down?
Up.
Up. Do you have any dollar amounts or anything over the last year or two, or percentage changes that you can calculate to put some analysis behind the trend? Can you calculate the dollar differences and the percentage change?
6 months ago, it was 1860, and now it's resting at 1813.
1813, 18. Why don't you go back further? Because it was, when I was teaching this class,
6 months
like
ago.
2 years ago, it was trading at 1600 for a long time.
back all the way, 5 years, it's trading 13, 13, it's 5 years.
Okay, so what's that, $500?
Yeah.
500? So what's 500 divided by 1313?
38%.
What is it?
38%.
0.38? Or 38%? So basically it's gone up like $500 since when?
Since 5 years prior, so like
2016.
5 years, or 38%. Can you give me some factors that would,
well, one big one, pretty much, well, the pandemic in essence, a lot of economic
Yeah.
uncertainty.
Geopolitical fear?
Yeah, as well as in 2016, you said the inflation rate was like on a trend up, right?
Yeah, inflation expectations, or inflation. What's happening to the dollar right now?
Appreciating.
Yeah, it's depreciation of the currency. Geopolitical risk, fear, depreciation in the dollar, inflation, those are all factors. Okay, what about bonds? Where's the 10-year Treasury yielding right now?
$1.26.
1 point what?
26.
1.26?
Went up.
Okay, got it. Where was it at the bottom of the pandemic? Wasn't it like 0.8?
0.53.
So 0.5, right? So we got 126 basis points minus 50, right? Basis points. How many basis points has the 10-year Treasury risen
76.
since the bottom of the pandemic? Plus 76 basis points. So basically, the yield is up, plus 76 EPS. And why have bond yields been trending up?
Interest rate law.
Huh?
The interest rate law?
No, what, using the Fischer equation, what are the two factors that drive interest rates up?
Inflation expectation.
Real rate and inflation expectations. So what, if the yield is going up, what does that tell you about inflation expectations? And inflation? Huh?
It's going up.
They're going up.
Going up, exactly. Got it. Over the last year, has the Treasury been selling more or less debt? More debt. Do we have higher or lower budget deficits? Higher. So if there's more debt that's being issued, what happens to bond prices?
They drop.
And what happens to interest rates? Do you think that could be one factor? Yeah. I mean, the Fed is buying up a lot of that debt, but they can't buy everything. So a lot of that stuff's gotta go into the market. So high bond supply could also be pushing up interest rates. Okay. Where's the dollar to the pound and dollar to the euro?
$1 to the euro, it's like $1 for the American dollar, $1.18 for a euro.
And where's the pound?
The pound's at $1.39.
3.39. Okay. go back, do you see any trend? Has it been trending up, trending down? Has the dollar been depreciating or appreciating? What's kind of the overall trend? Okay, so this has been going up, right? Do we have any metrics, any change metrics that we can put in there, either percentage changes or, I mean, theoretically, if the dollar has been depreciating under the theory, under the purchasing price parity theory, based on the Fischer equation, the theory is that the currency, the US dollar, will depreciate in the amount of the inflation rate. That's the theory.
Wait, you said the inflation rate is near 7%, right?
Right now, well, the long-term interest rate, inflation rate has been around 2% annually, but it's really been probably around 5, and it's currently probably around 10. Okay, the real inflation rate.
So
Not the one they report, but usually I've come to the conclusion that the inflation rate that they report, the real rate's double. So if they're reporting 5.4, it's probably 10.8. And just look at your, peanut butter and jelly sandwiches. Right? It costs me more for peanut butter and jelly and, wheat toast now. I do the peanut butter and jelly index. That's how I gauge my inflation. Because I eat a lot of peanut butter and jelly sandwiches. Okay.
Strawberry or grape?
Raspberry. It's only between raspberry and blueberry jam.
Party animal.
I love it. I love the blueberry. All right, do you have any percentage changes to kind of measure the depreciation in the dollar over the last maybe couple of years or something?
It has depreciated 7% over the past 5 years.
Okay, got it. 7% of depreciation. Got it. And what would cause the dollar to depreciate against foreign currency?
They appreciate or like...
No, what are the factors that would cause the dollar to depreciate against foreign currency?
Political uncertainty.
Yeah, political uncertainty. Do you think that January 6th freaked out a bunch of investors?
Yes.
Yeah, totally. What other factors would cause the dollar to depreciate?
Inflation expectation.
Yeah, higher or lower?
Higher.
Yeah. Okay, excellent. Anything else? There's a couple other factors that we just talked about that could be put in there.
Imports versus exports, and I just talked about that, but
Yeah, running budget deficits, or merchandise trade deficits. But we run a trade surplus on investment capital. So even though we run a merchandise trade deficit, capital flows into the United States through investments makes up for that.
okay.
So it's still a net surplus, but the trade deficit is negative, but the portfolio investments are positive. So net, I don't think it has a major effect, but go ahead.
I was going to say, it can also be like monetary policy as well.
Yeah, and then have we had restrictive or accommodative monetary policy over the last 10 years? More accommodative, right? So under an accommodative monetary policy, or interest rates usually higher or lower? Lower. So if the United States has lower interest rates compared to other countries, what's that going to do to the dollar? Are people going to convert in dollars to buy low yielding bonds, or are they going to convert into foreign currency at higher yielding bonds? Higher yielding bonds. So low interest rates. Got it. what's the fiscal condition of the United States? Has it gotten better or worse? Have we run bigger or smaller budget deficits?
Running bigger budget deficit.
Running bigger budget deficits, and if we run bigger budget deficits, do we issue more or less bonds to finance those deficits? More. And if we issue more bonds, does the debt outstanding shrink or grow? Grow. And if you're levering up your balance sheet and you're taking on more debt, is that more or less risky? More risky. So you have more sovereign default risk. Okay. The UDS would probably never default on their bonds like other countries because it's the reserve currency and it's such a huge economy. But some investors could receive higher risk premiums, higher credit default risk premiums. Okay. So fiscal condition. Okay. So that's basically that one. Okay. It's basically your review. A little ammo for your memos. Okay. Great. Did you guys get all that? Okay.
Yeah.
Okay, awesome. Now the next one is the dynamic asset class supply demand analysis. And on the course website, I have those lectures, so you may want to pull them up so that you can be engaged in that process. Do you know where those are? Yeah, right here. So, class notes. So the next two questions will be based on these right here. So you can pull those up and you can participate along. Okay? All right. So what we're going to do now is we're going to do a supply-demand analysis on the major asset classes. And this ties right into your memos. Okay? All right. So first thing we're going to do and this is going to be quantity. Price, supply curve, demand curve, equilibrium price, equilibrium quantity, market clearing price. Then we got the demand side. Demand, this is supply, this is equilibrium quantity, demanded, market clearing price, equilibrium. Okay, so when we set up these models, we always start in equilibrium and then we shock the systems. Okay, we're going to do stocks price. Did you guys pull up those notes? So you can feed me the answers. So the first market we're going to do is stocks. Okay. Or what we're going to do first is we're going to shock the supply curve. Okay. And we're going to shock the supply curve back. If the supply curve shifts back, what happens to the quantity supplied?
It reduces.
Yeah, it also goes back. And if the quantity quantity supplied shifts back, what happens to the price? What? Yeah, prices go up. Got it. So how would the supply of stocks, in the supply curve for stocks, how could it shift back? What would cause it? You can look at the notes.
I mean, if there's a huge sell-off.
No, that's not a sell-off because the supply curve is shifting back. If you sell off the bond, sell off the stocks, then the supply curve shifts to the other side.
Economic growth.
Economic growth is not going to shift the supply curve of stocks back. This is the supply side. You look at the notes.
Secondary offering?
Secondary offerings would push the supply curve out.
Stock buyback.
Stock buybacks. So if companies are interest rates low?
Yes.
Yes. And if you were a company and you had some money and you really didn't have to hire any people or expand your plant and equipment, what are you going to do? You have two ways to handle that money. What would you do? You got two decisions.
Dividends or stock
I can pay out dividends or I can buy my stock back. Got it. So stock buybacks. Okay. And how does that work? So I got earnings, right? And I want to do earnings per share. Right? That's really what I want. And I got my earnings. What do I do? Divide my earnings by?
How many units is
Shares outstanding. And if I basically take the surplus money, raise money in the bond market at 3%, and I buy back my stock, right? At a cheap, what happens to the shares outstanding?
The prices go up.
Yeah, what happens to the shares outstanding? If I buy back my stock?
Oh,
they go down.
They go down. And what happens to my earnings per share?
Goes up.
Goes up. And what happens to my stock price?
Goes up.
Goes up. Do you think companies will do that?
Yeah.
Yeah, totally. That's one way. What was the other one that was on there? I didn't really like that one, but it is theoretically correct.
Reverse stock split.
Yeah, I don't like that one. So reverse stock splits. So instead of a 2-for-1, right, when I split my stock, I give 2 for 1, 2 stocks for 1 stock. So I do split the stock, right? But when I do a reverse stock split, I'm basically getting 1 for 2. Okay, so that's artificially going to increase my earnings per share to inflate my stock price through an accounting gimmick. Okay. This is an accounting gimmick too. There's no economics behind it, it's just financial engineering, okay, to manipulate the stock price. And if companies start doing reverse stock splits, they're on their way out. Okay, they're desperate to prop up their stock price before it falls below $10, and they get delisted from the New York Stock Exchange. Okay, then they're done. Okay, all right. So that's one. What about what would shift the supply curve for stocks out, causing the quantity supplied to shift out and the price to do what? Go down. Got it. So what would cause the supply curve to shift out?
Initial public offerings.
Yeah, so IPOs. There's got to be a lot of tech companies coming out. Isn't that what happened in 2001 after the dot-com boom? I mean, some of these companies were trading at 1,400, price earnings multiples. It's freaking nuts, right? made no sense whatsoever. These companies flooded the market, and then when the market crashed, their stock prices crashed with it. So initial public offerings would shift out the supply curve. It's not a lot, but could have an effect at some point. What would be the other?
Secondary offerings?
What is it?
Secondary offerings?
Secondary or seasoned offerings. Companies see that their stock prices are inflated, they rush to the marketplace, they issue more stock. Secondary offerings, seasoned offerings, and they basically shift the supply curve out and drive overall stock prices down. That could happen. It's not a big influence, but those are the only factors that I can think of, unless anybody has an accounting background or finance or econ, and you can think of any other factors that would shift the supply curve for stocks back and out. Anybody have any others? No? It's all I can think of. Okay. And what do I know? Okay, so the next is on the demand side. What would cause the demand curve for stocks to shift up?
PCD?
The quantity demanded to shift out, and the price for stocks to go up. What are the factors that would shift the demand curve out or up?
Economic growth.
Yeah, economic growth. Okay. And if you get economic growth, what happens to top end revenue? Goes up. What happens to earnings? Goes up. And earnings per share? Up. And stock prices? Got it. Okay, what else?
Higher employment?
Yeah, employment growth. More people are working, what do they get? What do they have? Higher wages. And then what are they going to do with the money?
Spend it.
Spend it. And the money they don't spend, what are they going to do with that?
Invest it.
Invest it. Exactly. Okay. What else?
Higher returns on earnings?
Yeah, higher returns. See, I got some money. I can buy a 10-year Treasury at 1.25, or I can invest in the stock market. It's more risk, but I think I can get a higher rate of return. What was the return over the last year? What, 23% on the stock market? So I can get 1.25 on the 10-year Treasury, or I can get 23% in the stock market. Where am I going to put my money? Probably put it in the stock market. Okay, so higher expected returns. Any others?
Macroeconomic risks?
Huh?
Macroeconomic risks?
Well, would that increase the demand?
Lower.
Let's finish the demand side. What else would cause demand for stocks to go up?
Interest rates?
Higher or lower?
Higher.
Lower or higher?
Lower.
Lower. Lower and falling?
Yes.
Lower and falling interest rates. When interest rates are falling, what's happening to the equity cost of capital for the firm?
It falls.
Cheaper.
It goes down. What about the weighted average cost of capital?
Goes down.
Goes down. Got it. And if the discount rates are going down, what happens to the value of the stocks?
Goes up.
Goes up. Got it. Okay, anything else? Any other factors that would drive up demand? You can look at the notes.
systematic and political interest rate?
Okay, anything else that you can think of? Okay, what would cause the demand curve to shift down? And the prices of stock to fall. Can we just reverse these?
Yes.
Economic contraction, recession, high and rising unemployment. Layoffs. Brutal. Lower. Lower expected returns. If I could get 5% on a 10-year Treasury, and I think the market's going to go down 20%, what am I going to buy? Treasury yields, risk-free at 5%. Okay. High, rising interest rates. So when the risk-free rate is rising, your cost of equity using the cap M, what's going to happen to your cost of capital? It's going to go up. And what about your weighted average cost of capital? It's going to go up. And if your weighted average cost of capital is going up, and that's the discount rate that you're using to calculate present values and net present values and internal rates of return for investment decisions, and you start to have more negative net present value projects, are you going to grow?
No.
No. Okay, no, exactly. All right, so that's that. So that's basically your stocks. Everybody get that? I'm going to keep this part so I don't have to do this over again. Okay. Let's do the oil market. Okay, got it. So what would cause the supply curve to shift back for the oil markets? Causing quantity supplied to shift back and prices to rise.
Okay.
Yeah, cuts in production by OPEC. cause the supply curve to shift back?
Geopolitical problems in the Middle East.
Yeah.
Supply disruption, basically.
Yeah, supply chain disruptions through the Straits of Hormuz.
Or a tanker gets stuck in the
Yeah,
sea.
exactly. So, geopolitical. Anything else?
We're going over what makes oil cheaper.
What's causing the supply curve to shift back? Quantity supplied to shift back and prices to rise.
I mean, this isn't really short term, this is more so long term. Pretty much political policies surrounding like more fuel efficient cars and more fuels. Long term, no, it's not really short. Initiative.
Was that gonna come from the supply side or the demand side?
It's become more. So
Are they shifting, is the supply curve shifting back because people are using less oil?
No.
Or are they using less oil because of demand? Is it coming from the demand side or the supply
I
side?
think that would more so come from demand, but
Yeah, eventually it would probably affect supply, but I think it's more on the demand side
yeah.
here. Okay, anything else?
If they like open up drilling in areas that were previously not open, that could increase the supply, yeah.
Okay, so you're basically saying shift in the supply curve out, which would increase supply, which would drive prices down, would be due to what, technology, did you say?
Yeah.
So if there's technology that, well, what's that called in the United States? What was the number one technology that,
Fracking?
yeah, fracking. Yeah, the United States became an exporter of oil for the first time like 3 years ago. For the first time ever, because of fracking, because of the technological innovation. What else would cause the supply curve to shift out?
And lack of inventories?
Huh?
Lack of inventories?
Well, the lack of inventory would cause the supply curve to shift back.
Oh, we already doing that, oh.
So what would cause the supply curve to shift out?
Selling the OPEC reserves.
What was it?
Could be selling reserves, oil.
Selling reserves? How about increased production by OPEC?
We say geopolitical dealings with Iran and oil reserves.
Okay, we'll try that. Increased production, OPEC. Iran. Selling. In global market. Okay, what else? I don't know if that's one, that's probably more demand side.
How about sanctions, geopolitical sanctions can impact the supply?
Sanctions, wouldn't that be here? If they impose sanctions, wouldn't it restrict the supply?
It would restrict, but if you remove it, it could
Okay, got it.
open it up.
Okay. Okay, that could be that. All right, anything else on the supply side? No? Yes? No? From the Zoom gallery?
No,
Okay, got it. Let's do demand side. What would cause demand for oil to go up?
Economic growth pretty much in the industry.
global. Is oil a global commodity or just
Global, yeah.
domestic? What countries consume the most oil?
US,
Russia.
China,
Russia?
India.
India,
India, China, India, who else?
US.
Yes, US, who else? Who are the Europeans buying oil from these days?
Russia.
Russia, right, so Europe. Got it, there's one more. What's another export-oriented economy? Major.
China? Is that forward-oriented, right?
What other country exports a lot and doesn't produce any oil and has to import it all?
Canada?
I think Canada has its own oil. No, I'm thinking about a major, one of the largest exporters in the world. And it's been one of the largest exporters since post-World War II.
Germany,
I know Saudi Arabia produces.
Germany would be good. Does Germany have a lot of oil reserves?
not that I know of.
Well, you're missing one more.
Mexico,
No, Mexico's economy is not very big.
UAE,
The UK,
UAE, Arab Emirates.
don't they sit on like one of the largest oil reserves in the world?
One of the Asian countries?
Which one?
Japan?
Korea.
it's over me.
Don't forget Japan. They're called the Southeast Asian Tigers. Indonesia, Singapore, Malaysia, Taiwan, Vietnam, all rapidly growing. Do they sit on oil reserves? Huh?
Malaysia?
Malaysia, exactly. Do they sit on oil reserves?
No,
Do they have to import a lot of oil?
yeah.
Yeah,
How
exactly.
about Venezuela? They also.
Venezuela exports oil, but their economy is in shatters. Okay, what else? What else would shock the demand curve up and out, driving the quantity demanded out and prices up?
I think technology again, because if you find new technology to use oil like plastics or different ways to use it, Bitcoin, it's a lot of energy.
Maybe they find technology and re-engineer the carbon out of it and then repurpose it. That's gonna increase demand, maybe. Any other factors?
Employment and production growth?
Yeah, employment. Economic growth would be considered production. What else? What's been happening since post-World War II?
Global? Oh no.
Globalization.
That's a good one. Globalization. Okay, what else? Give me one more. There's one more that we're missing. That would increase demand for oil.
Population growth.
Travel.
Right? Although population growth is there's no population growth, actually population is shrinking right now for the first time in like 80 years. What did you say? Somebody on the Zoom said something.
I said travel.
Raise in travel. Because you need jet fuel. Okay. What would cause the demand curve to shift down? Quantity demanded to shift back and prices to fall.
The opposite.
Yeah, recession. Productivity, right? I can engineer manufacturing to use less carbon, right? Oh, that's a good one too, right? Renewable energy. Right, that's going to be a substitution effect. Start to burn less oil, we do wind, geothermal, biogas, solar. We're not going to need, as much carbon oil, petroleum.
Did we see a big decrease in demand during the height of COVID? Because everyone was sort of like throwing it out.
No, oil prices actually, future prices turn negative. So that could be here, right, pandemic. That was lockdowns. Recessions. Depressions. Oh, I got one. I got one for here. How about wars? Does demand for oil increase when you have lots of wars?
Yeah.
Yeah. And then we could, down here, we could put peace. We talked about contractions, we talked about recessions. Technology can also do that through the substitution effect. Any other factors that could cause the demand curve to shift down? Anything else on those notes?
It says price elasticity.
No. I think those are most of them. Usually when you set them up, you can just reverse them. Oh, is population contracting
No.
in the world? No, it actually is.
Huh?
Yeah. The United States basically had zero population growth or negative for the first time because of the pandemic and the opioid crisis.
And baby boomers.
Baby boomers are dying off fast.
Really?
I thought they were living longer.
Huh?
I thought people were.
They're just getting older and crankier. Population contraction. Yeah, China's now giving incentives to have more kids because their labor force is getting older.
Wait, did
Not
they
allowed
reverse
to have
the one-child policy?
Yeah.
It was only
Huh?
2 times.
Thank you.
Did they reverse the one-child policy?
Yeah. Okay, anything else on here? All right. So let's do gold. Okay, did you guys, the Zoom kids, did you guys get this?
Got it all.
Got it. Perfect.
I'm impressed you fit all of that on one screen too.
Huh?
I was saying I'm impressed you fit all of that on one screen. I couldn't even fit it all on one page.
Oops.
I think you might be able to encircle stuff to make it go faster.
Huh?
You might be able to just like circle it.
Can I?
Possibly, probably. Let's find out.
Really? There's probably a better way to do this, right?
Gotta be.
There's gotta be. Just, you know, I'm just,
There's probably an option to clear the page.
I'm sure there is. But that would be too easy, wouldn't it?
Yeah,
I like to make things really hard for myself.
I respect that.
Alright, what's the next one, gold?
Yeah.
Alright, what would cause, oh, this is tough, gold is really hard.
It is, it's not at the same time. That's a good one.
It's not easy, this one's really hard. What would cause the supply curve of gold to shift back? I think I figured out some of them, but you guys might have better ideas.
Hoarding,
Yeah, hoarding.
central bank,
Do people hoard gold?
yeah.
Yeah. Do central banks hoard gold?
Mm-hmm.
I don't know, do you guys, and it doesn't, does gold bars deteriorate?
No.
No, they last for freaking ever. I don't know, anybody else? I couldn't really figure out anything.
What does it say?
Did you argue anything if there was like an uptick in jewelry sales or something, that uses gold?
That's on the demand side.
Wait,
Oh, sorry.
I think that, political issues with like countries where like mining is done, like I know a lot of gold mining is done in Africa.
So let's say, how do you say that? You said what? Geopolitical risks in gold producing countries. Is that what you were saying?
Yeah.
Right, because nobody's gonna be able to mine for gold if they're in a war. Okay, that could be what, anybody else? That's a good one, I didn't think about that. Okay, what about, what would cause the supply of gold to shift out? Well, when people aren't hoarding gold, what are they doing with it?
Selling.
They're selling it.
Melting it down and turning it into other things.
Right, people. And, banks. Right, countries, banks, central banks. And if they're selling off their gold reserves, what are they using the money for?
For investing.
The governments, in most cases. If they're selling off their gold to get foreign currency,
They're buying stock.
no, what are they
Trading.
doing?
They sell the gold and they buy.
They're selling the gold for a reason. So it's like the last thing you do is you sell off your gold. So why would companies be desperate to sell off their gold reserves?
Yeah, that.
Exactly, to pay off debt, right? So they're in some kind of financial situation where they're desperate to sell off their gold to basically get foreign currency reserves to pay off their foreign currency denominated debt. Okay, that's a good one. Okay. What else would cause the supply curve to shift out? We mentioned it in some of the others.
Technology.
Yeah. Is that what it's called? Is it called extraction?
That's what's on the desk.
Yeah, but I'm not sure I did it right.
Mining.
Mining, okay, mining. I'll call it extraction. Mining extraction what?
Improve.
Technology.
Yeah, technology, right? If it's cheaper, if you can find it, and get it out of the ground, it's gonna shift the supply curve out and cause prices to go down.
What about like trends? Like if it becomes trendy and,
Yeah, cultural shift.
yeah.
Yeah, China and India are like one of the biggest purchasers of gold, because they use them for dowries
Yeah.
and stuff,
On
and
top of,
status and store of wealth. Yeah, that's a good one. Any others?
Liquidation sell-off?
Huh?
Says liquidation sell-off?
Liquidation? That's what we're doing here.
Selling.
Right here, the selling by the central banks, liquidation. And then the cultural shifts, that's a good one. Okay, anything on, let's do the demand side. What would cause gold demand to go up? Why do people buy gold?
As a safety, never goes down.
Safety,
Like what, economic uncertainty?
hedge. What else? What are they hedging? Where are they buying gold?
inflation.
Yeah, inflation. And what else?
Geopolitical instability.
Yeah, economic. Geopolitical uncertainty. Inflation, and if an inflation is running high in one country, what else is happening? What are they scared of?
Recession.
Well, we already have economic uncertainty here, so they would buy gold because of economic uncertainty. They would buy gold in a recession. They sure did in 2008 and 2009. But if you have high inflation in your country, what's happening?
The dollar's depreciating.
Yeah, you're getting depreciation. Currency. Your currency is devaluing, so you're trying to hedge it off.
Isn't gold also used a lot in like computers? So
You could,
that could
you could put that in, industrial. And consumer. Manufacturing. You could put it in there. It's an industrial, good. Why don't you reverse this one? And do this one again. Maybe gold becomes trendy again, right? So cultural. And cultural shifts. And just culture, right? Certain cultures, particularly India and China. Anything else that you can think of that would increase the demand for gold? No? What would cause demand to go down? Quantity demanded to ship back and the price to go down.
economic certainty.
Yeah. consumer substitution. What else? Economic growth. Economic recession. Right, and deflation. Right, disinflation. Currency. Revaluation, appreciation, low inflation, this one's falling prices. Cultural shifts. Industrial consumer, deflation, currency appreciation, economic certainty, anything else? That's it. Okay, you guys got that? What's the next one, bonds?
Yes. Any chance we can get a quick break?
Yeah, go for it.
Okay. Wait, are we gonna continue? I don't wanna miss it.
No, I'll wait.
Okay, so we're all taking a break?
Yeah, go for it.
Okay. Why? We're taking a break. Oh.
Eat some of those cookies, please.
That's it.
Thank you.
I need to drink a little bit.
Wait, no, it was there.
All paid 5%.
I don't think it was here today.
What's here, right?
No, it was here before, but it wasn't here Because if not, I'm gonna have to review everything over the course of the weekend. Silver.
Oh, yeah.
Oh, that's all?
No, I think like the mix of both.
Oh,
Do you
okay.
guys still, yeah, no, Netflix coming soon. I was gonna order some bracelets.
Oh, yeah?
I love these bracelets.
No, I didn't.
Wait, what?
Yeah, they make them out of glass and so cheap, it's like $2.
Oh, really?
Yeah,
Are you sure it's real?
Wait, glass?
yeah,
What's it?
glass.
Oh, like
glass.
glass.
I thought you meant gold. I was like, what?
Okay, no, okay, I thought, okay, I thought you said glass, like a piece of glass, like, wait.
Oh my god. It's just like that because it's already marked.
Yeah, so.
I have a glass.
Yes.
So I'm waiting, it's not
Oh. Okay, I'm
He asked me to like, when is it ready? It's not on the program. When they go in.
Well, mostly because I'm gonna move here. It's like 5 miles away. It's like literally like right up the street. It's like it's one street called Alice.
Oh, okay.
Yeah, it's literally like straight left. You're there. It's like 4 minute, 5 minute drive.
Not if they're, yeah, I'm waiting.
Yeah.
Go for it. Go for it.
So, she said that he said to her that we need to figure out when it's the due date certificate, but we asked already.
What did she say?
Oh, no, okay.
Erin.
But she's out of office. I think the value, the word the value of the
I don't have to ask her, right?
and she said,
Usually they don't do it the same day.
no, she said it's 1 2 weeks after,
Yes.
like, when it's
After
done.
the last day of class.
Last day of the class.
Okay.
You see, he said they have their set, not this, as far as I know, they have their own set system.
Hey, is this still recording?
He doesn't know.
Yeah.
He said
Oh, I was gonna ask a question.
Okay, I'll come back.
after the last class.
Yeah. So.
So it's already going.
Yeah. Sorry, I wasn't able to make it to like our scheduled meeting. Thanks.
Okay.
After class, we have some time. Can you go look at my memo for me, my stuff?
Yeah.
Okay, yeah, there's that. And I also have one additional question. I'll wait about that.
Oh, yeah.
Okay.
Thank you.
Probably was too heavy.
Can I set up another meeting with you to go over?
Do you still need a
next week.
charger?
Okay.
What? You need a charger?
It's not like.
I got Jackson's. Thank you so much. I'm sorry, I forgot to mention.
When's the grades due?
The grade deadline, it's I'll double check it, but it was at least a week past, if I'm not mistaken.
Yeah,
I'll double check.
yeah, you have until, the grades are due.
Okay, but I just wanted to go through my memo, the rest of it.
Yeah, also,
Okay.
Yeah.
also one more question, so
So
like,
we need to
is
schedule another one?
it normal for St. Mary's students to like have 5-week courses?
The auditor.
Or is it like 10 weeks of standards, we have like a period of 5 weeks, I just want like,
And also, yeah.
in your experience, you have like a, what do you think?
Let's say that again.
No, see,
Okay, so like, is it normal for St. Mary's to have like 5 weeks
I know,
classes?
Well, you guys are 2 units as opposed to 3.
Oh.
So it's different credits.
Okay. In that case, I'll just double check with the office.
Yeah, and then usually I don't know, can you look it up?
When grades, I know they have it for the
Oh, no.
no.
Okay.
I'm gonna schedule my follow-up session with you
Okay.
next week.
Okay.
Yeah.
After my other meeting.
Oh, really?
Yeah, we have to.
Yeah. That's what I recommend, you guys do is, focus on your other classes and then use the extra week afterwards to finish up your stuff.
So for the signature, so I can clear, you had mentioned that we could turn in
Yeah,
as an, okay, so we should keep it along.
yeah, exactly. Unless you want an exam. No, because it's a lot of work already just to take the notes and stuff.
It is, I'm tripping it a little bit every day, but no matter. And so,
Yeah. No, I decided, after COVID, it was really hard to get the exams. And I just decided that, what I'll do is just,
I always watch my.
you do the workload, you upload, you take the notes. That's like, it's like a tape, exam. So it just makes things easier.
I will try to this though. Like when I'm after that school or
Yeah.
and then all the classes, when I know the breaks,
Yeah.
Instead of looking around or necessarily extra hours, I can just sit and write in the sequence.
Is it?
Like,
Really?
yeah, all I'm doing is writing and sitting there.
Yeah.
It's like minutes in a way.
Yeah, exactly.
And it's like I realized the other day, like I need a break and I started doing it. And I'm like,
Oh, really? Yeah, awesome.
and then once I started, it's like,
Yeah. I try to get a lot of my students to start really realize that they have to take notes, in business. And then you gotta rewrite it. So it's like, you gotta do it.
one of the practices as a project manager, you have to take notes.
Totally.
Especially if you're speaking a language that you're not used to, like, it's different industries, it's different companies,
Yeah.
like you have to get it right and have it.
I like to, when I have projects, if I'm working I want everybody to take notes. And then I want somebody to consolidate that. And then I use the notes as part of the workflow, for evidence, if they ever, so that they didn't do anything or talk about something or didn't. I got all the evidence.
Makes perfect sense.
Yeah.
We need to go once in a spring to
Okay, I think presently, so inflation.
Oh, really?
Yeah.
Especially when they're really
So I
good.
think inflation's going up, so the bond prices must be going down for more money into the economy to re-stimulate it. Or is it already want to cool? I'm just tired.
What?
I'm like, it's like running through my brain and I'm like, wait, this goes up, this goes down, this should go up or down.
I don't know what I'm doing. I'm gluten free, unfortunately.
Oh, yeah. You're on diet?
Oh, no. I'm gluten free, unfortunately.
Oh, I wish I was. I was this kid here.
No.
Oh, so I asked the professor yesterday about the exam. He said the data analysis. He said it's gonna be like the homework if you need with a final each question.
Yeah.
And I asked if the problems are gonna be like the homework. He was like, no, it's gonna be easier. Like you're gonna have an 8, so you need to make it on time. They're gonna be easier. I hope it is so.
I trust
you.
Yeah, no,
He said,
yeah,
he said it's
he
gonna
said
be
that.
easier, so. I don't
You know, it's hard for himself to do some of them with us, so.
Yeah,
He knows for the exams, he doesn't want to.
okay, I was wondering.
Newspaper. Basically, they don't want us to do that, so.
We need to get a 3.0. Are you guys following
I
the
don't really
Olympic
care
Games?
about my.
Wait, the what?
Not really,
No.
I didn't.
Wait, what did you say?
Olympic Games?
Oh, this is Hunger Games.
What was
No,
the matter?
Olympic Games.
You want to say that? No, not really.
Like,
I know
why
a
does
little,
it
but not really
think
like
that,
Hunger
oh,
Games.
yeah, I'm paying so much money, I wanna make it
Professor,
work.
did
Like,
you see
work
that
hard for it, you know?
the lady that you mentioned from Brazil, she lost the game with the pink hair?
Oh, what?
What was her name?
I've
Leticia
been there.
Mufani, something like
Was
that?
she a gymnast or something, or? Oh,
The Brazilian that you showed me the video from
Oh.
skate, she lost it.
and she was in the Olympics?
Yeah.
Oh,
she did it.
really?
And then the 13 years old that I told you,
Yeah.
she got the silver medal.
Oh, that's awesome.
Yeah,
Nice.
but she was, I think she hurt her feet.
Oh,
That's
really?
why she didn't make it.
Oh, she's amazing.
Yeah, but she was good.
Did you see that on the
Yes.
X Games?
What was that?
Did you see her, the Brazilian woman who was doing X Games, she won like
Oh,
the
yes.
gold?
Uh-huh.
She was amazing.
My roommates were telling me.
I know.
They're not human.
No, you're bad. This is real. They're amazing.
Yeah, I know, it literally looked like a real life, like, it was like a photo.
Alright, let's finish the last two and then,
Really scary, honestly.
and then I'll finish, the rest of it next week. And then if I have time, I'll do one of the problems from the final, so I can run you through Now, have you taken the finance classes? No? Okay. So I want to do one capital budgeting problem for you. So you can, when you go into the finance class, you'll have you will have been through it once before. Okay. And that's really the microeconomics. When you're doing investment decision making, you're basically evaluating a transaction and then you're making an investment decision. Okay. So I'll walk you through the investment decision making process. Okay. All right. Excellent. Whew. All right, let's do this. All right. So this is a good one. What would cause the supply curve to shift back for bonds? And it's in the notes.
Budget surplus.
Yeah, budget surpluses. We've never, the Clinton administration was the only one that actually did it. Engineered budget surpluses. They had so much money that they bought back the bonds in the marketplace, driving up bond prices, driving down interest rate, and expanding the recovery from it. So budget surpluses. And then I would call that a bond buyback program. What's another one?
Maturity.
Yeah. So bond maturities. So basically, as the bonds mature, they don't replace them. Okay. So bond maturity, no rollover, no replacement. And this would happen, only if you had a budget surplus. Okay. And that's actually the theory of the Federal Reserve. Is that when they print this money and they buy those bonds and put them on the balance sheet, they can never sell the bonds off, right? Because if they dump the bonds, bond prices would go down, interest rates would go up, and we go into a recession. So the Federal Reserve basically buys the bonds and holds them through to maturity and allows them to expire, okay? And then the Federal Reserve gets the interest on the bonds and the principal and gives it back to the Treasury. And that's one thing that I've heard that's never discussed, is that maybe the Federal Reserve can continue to print money and buy bonds like the Japanese have for decades, racking up huge fiscal debt to the point where, and this might be the solution of the ballooning balance sheet and the debt for the government, is that at some point in time when the debt levels get so high and the Federal Reserve's balance sheet is too bloated, that the federal government comes in and cancels the debt, forgives it. Never been done before, don't know the implications and ramifications. There's really no economic theory on it. Nobody ever talks about it. I don't know, it's just something they talk about.
Just out of curiosity, so could you think something like that could ever be done on a global level for like country to country debt, or no?
Well, the theory is that the first country that would do it is Japan, because they have such huge fiscal debt and the central bank's balance sheet is so bloated. They would be the first to do something like that. I don't know, I'd have to go back and do some historical research and find out if there's any countries that have done that in the past. Not in the modern era. Can you think of anything else, or is there anything else in those notes?
No, open market,
Yeah.
operation holding?
Well, I mean, when they're buying the bonds, right, on the demand side, they're pulling supply out of the market. I think it's more of a demand side as opposed to a supply side function. So when the prices of the bonds go up, what happens to interest rates?
Go down.
Yeah, they go down. Got it. Okay. So let's flip this. And what would cause the supply curve for bonds to shift out?
Budget deficit?
Yeah. Right? Because they have to issue bonds to finance the deficits. Okay. What else?
Foreign sell-off.
Huh?
Foreign set-offs.
Yeah, bond sell-offs. That's a good one. Do you think Saudi Arabia, Japan, and China, at some point in time in the past and maybe in the future, would sell off their U.S. government Treasury securities?
Maybe.
Maybe push down the dollar and push up their foreign currency values?
Yeah.
Or maybe use, right, the purchasing and sale of U.S. Treasury securities to manipulate the currencies, to peg the currencies within a band, right, to continue to promote the exports.
Yeah, doesn't China buy a bunch of American bonds to keep the American dollar
Yeah.
higher than theirs, so when products are sold, they make the money?
Exactly. Yeah, they will take the dollars that they got from the exports, take the dollars, buy U.S. government, or buy U.S. dollars, driving up the dollar, driving down their currency values. And then they invest in U.S. government securities. So what they're doing is what is called immunizing their currency by basically, through currency manipulation, to basically peg their currency below where it should be, to keep their goods cheaper in the global merchandise markets. Okay, all right, excellent. So bond sell-off, that would be a good one. Budget deficits. And then you would do bond replacements. So as the bonds mature, they don't roll off, they're basically replaced immediately with new bonds. Okay. All right. Is there anything else in those notes? No, okay. And when they sell off the bonds, or when the supply curve shifts out and the quantity supplied shift out and the prices drop, what happens to the interest rates?
Goes up.
They go up. Got it. Okay. Got it. All right. And then what would cause demand for the bonds to go up? What about low inflation or falling inflation?
Yeah.
So if low inflation and falling inflation and expectations, and what happens when you have low inflation and low inflation expectations? What happens to interest rates?
Is that high interest rates?
Huh?
Is that high interest rates?
Well,
Or low?
What do you buy bonds for?
Safety?
Yeah, safety.
Guaranteed money.
So people want more safety.
Yeah.
Now, are U.S. government Treasury securities highly liquid or illiquid?
Liquid.
Yeah, they're highly liquid. So people want liquidity. Move out of the stock market, move into the bond market for liquidity purposes. What else would drive up demand for?
Geopolitical.
uncertainty?
Yeah.
Yeah. Right, when there's wars or uncertainty, they go into US government bonds for safety. Okay, what else?
The fair is gonna go to safety, right? It's for safety.
Huh?
Fair.
Fear?
Would
Yeah,
be
yeah,
part of
geopolitical
safety, right?
uncertainty.
Recession.
Recessions, right, we'll put that up here. Right, because if you're going into a recession, what happens to inflation? It goes down. What happens to interest rates?
Go down.
They go down. What happens to bond prices?
Go up.
They go up. Okay. Okay, so you can benefit that way. What else could drive demand for bonds? What about, this is counterintuitive, right? Because during economic expansion, there's higher inflation, inflation expectations, interest rates, which causes bonds to go down. But if people have more money, are they going to invest in bonds? Yeah. So I would say, you know, maybe some kind of economic, some kind of wealth effect, some kind of savings, you know, and or investment effect. You know, people have more disposable income. Let's just flip it, right? What would cause bond demand to drop and prices to drop? And when prices drop, what happens to interest rates? They go up. And when prices rise, interest rates go down. Got it. Okay. So let's flip it. High, rising inflation. Expectations. Recession, recovery, growth. When the economy is recovering and growing, are you going to be in bonds or are you going to be in stocks?
Stocks.
You're going to be in equities or real estate, right? High, rising interest rates. Right, because we know as the inflation expectations, interest rates move up, bond prices are going to go down. Okay, so you're not going to want to be in there. Demand for bonds are going to go down when there's going to be less interest in safety and liquidity, and people are going to be looking more towards risky investments like stocks. People will have more risk appetite. Geopolitical certainty, less fear, economic wealth, so spending, consumption, as opposed to savings. Anything else on that list?
Peace, stability, because decrease, business cycle, less.
And you could put in for both of these, two. You can do open market operations, because the Fed is gonna buy and sell bonds. Playing here on the demand curve and probably over here too. Okay. Anything else? One more, we're almost done. Okay, can I erase this? Okay. One more. And what we're going to do now is we're going to do US dollar or USD against foreign currency or FX. And we're not going to do the price of the dollar, we're going to use value of the currency. We're going to do this against foreign currency, FX. Okay, almost done. Okay, what would cause the US dollar supply to shift back?
Inflation, there's a lot of money, more is worth less.
I was thinking about that. Is that correct? So inflation would deteriorate the...
Yeah, I mean, if there's more of anything, less scarcity, less value, work.
Yeah, but inflation actually causes the dollar to depreciate.
To depreciate?
Yeah. So that, you know, you're on the right track, but I'm just trying, you know, that's what I was thinking. Is that, you know, the dollar would depreciate. That inflation would deteriorate and cause the dollar to shrink, right, in supply. But if that's the case, then the dollar would appreciate. So it's kind of counterintuitive. We'll have to do some research to figure that out. We'll put it there. Why don't we just say, oh God, how do we do it? This is a tough one.
So we're looking for when the supply shrinks?
The supply of dollars shrinks. Because we know that, you know, if the Federal Reserve prints money, right, prints more dollars, that's gonna increase the supply and cause the dollar to devalue. So what's the opposite?
Hoarding?
I think so. So this is value, 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 value. So we have to change it. Hoarding. Precautionary. Let's go precautionary balances. Where people will take currency out of the circulation and stick it under their mattress because they're scared.
With a decrease in the velocity of money.
Yeah, that's interesting. I like that. Yeah, never thought of that. Collapse. Decrease. Velocity of money. I think you're onto something. Contraction.